There is a category of wealth that does not appear in business school curricula. It is not built through salary negotiation or portfolio diversification or disciplined saving. It is built by people who were hired for what they could prove, not what they could sell. The entry point is a mathematics department, not a trading floor. The credential is a doctoral thesis, not a Series 7 license. And the compensation structure waiting at the other end of that path is so far outside normal wage expectations that the first number lands without a frame of reference. This is not a story about finance. It is a story about how certain institutions harvest a specific kind of intelligence and convert it into something permanent. The people inside the system rarely describe it. The firms that operate it have structural reasons to stay invisible. What follows is a map of that system, built level by level from the outside in. Understanding it will not get you inside it, but understanding it will change how you think about the relationship between knowledge, capital, and time. The pipeline does not begin with a job application. It begins inside a doctoral program at a school whose name functions as a signal. Mathematics, statistics, physics. 5 years of funding, tuition covered, a stipend that pays for essentials and not much else. The work at this stage has no visible market application. The researcher proves theorems, develops results in stochastic processes or high-dimensional probability, teaches calculus twice a week to keep the funding structure active. The thesis lives at the boundary between two fields that do not yet share a language. That boundary is the point. Most people avoid it. The right kind of researcher moves toward it. Year 2 produces a published paper, narrow, precise, citing work in fields adjacent to the researcher's own. It enters the academic record and is largely forgotten by its author. Year 3, the thesis begins to cohere. The answer becomes visible before the proof is complete. The researcher lives in the gap between knowing and demonstrating. Year 4, a conference. The first chapter of the dissertation is presented to a room of 40. 36 are academics, 4 are not. One of the 4 approaches during a break and hands over a card with no company name, just a name and an email address. He mentions a preprint. He uses the word interesting. He uses it the way someone uses a word when they mean something they have decided not to say directly yet. The researcher emails that night. A call follows 2 weeks later. The questions are not about career goals. They are about research direction, thesis timeline, and whether the researcher has thought about applications in environments where probability distributions behave in ways that standard models do not anticipate. The researcher says no, then says yes anyway. What happens next is not a hiring process in the conventional sense. It is a sequence of evaluations with no declared rubric. More calls follow, then 2 days of in-person assessment, probability problems, a combinatorics session that runs past 90 minutes, a room where a senior researcher hands over an unfamiliar derivation and watches how the candidate moves through it when the answer is not immediately available. There is no grade given, no debrief. The candidate leaves without knowing how much of it was correct. 3 weeks later, an offer arrives from a name that belongs to a small category of systematic investment firms that treat a mathematics doctorate the way elite banking treats a top business school degree. The total first-year compensation figure is not a salary. It is a package, base, signing bonus, and a guaranteed performance component. The combined number sits near a threshold that most professionals take 15 years to approach. The researcher deposits the signing check and experiences something that is not excitement. It is closer to disorientation. The number exists without a prior reference point. The office does not look like a trading floor. It is quiet, dual monitors, notebooks beside keyboards. The ambient sound resembles a research department at a university. The output does not. 20 researchers, $6 billion in managed capital. The silence is the product of the environment, not the scale. The first assignment is to find signals. A signal is a statistical pattern in data that predicts future price movement, with an edge that survives transaction costs and degrades slowly enough to justify deployment. The definition is clean. The work that produces a valid signal is not. The first 3 months are spent mapping what has already been tried and failed. Literature on factor models, microstructure, alternative data sourcing, risk premium frameworks. Every paper annotated. No one asked for the annotations. They are the map. The first signal memo takes 3 weeks to build. Satellite imagery of commercial foot traffic correlated with retail earnings surprises. The back-tested edge is real. The presentation takes 11 minutes. The portfolio manager reads the summary in 4. He says 1 word, pass, no explanation follows. The researcher spends 2 days looking for where the signal broke. The answer never appears. The second memo takes 12 weeks. A volatility pattern in currency markets during a narrow window following central bank communications. The PM reads it, he says, interesting. The researcher learns later that interesting is the strongest word he has used about any submitted research in 6 months. The signal goes into the book. It runs 90 days live. It holds out of sample. The researcher never learns what it generates in actual profit and loss. Nobody provides the number. Asking for it would reveal a misunderstanding about the nature of the arrangement. Near the end of year 2, a number surfaces at a team lunch. Mentioned offhand, the way you mention something that requires no context. A signal written by a researcher who left 4 years ago is still running in the book. Cumulative alpha generated across that period, $340 million. The researcher who wrote it is now at a university on the West Coast, publishing academic papers. His signal is still running. It will continue running after he is gone. The arithmetic involved in that fact does not resolve easily. By year 6, the researcher is no longer building signals. The work has become structural. A strategy is not a signal, it is a framework, a systematic structure that trades across dozens of instruments in multiple asset classes, combining many individual signals under a single unified risk model. Some of those signals were written by researchers who are no longer at the firm. The current researcher inherited their code, tested their assumptions, identified which conditions had stopped being true, and rebuilt from the interior. This is called research. It resembles archaeology more closely. The central problem at this level is not quality, it is capacity. The best performing signal has a deployable ceiling. Above a certain capital threshold, the positions become large enough relative to available liquidity that executing the trade begins to move the price the signal was designed to anticipate. The edge destroys itself. Months of construction produce a result that is mathematically sound and commercially limited. The portfolio manager is informed. He nods once. The work begins again. The pressure here is not external in the way that most professional pressure is external. The hours are chosen, not assigned. 6 months can pass in which every hypothesis tested fails out of sample. The market shifts its structure, and the signals calibrated to the previous regime stop working. The work restarts. The best technical paper the researcher has ever written is produced for an internal research conference. Nobody outside the building will read it. Then a recruiter calls, not about a research role, about a portfolio manager seat at a multi-manager fund with substantial capital under management. The offer is autonomy, the researcher's own book, the researcher's own signals, the researcher's own capital allocation decisions. The call is not returned for 3 weeks. When it is, the answer is no, not yet. There are still things to understand before the grade becomes permanent. The understanding arrives gradually and then all at once. The alpha is not in the signals. Individual signals can be built, tested, documented, inherited, and improved. They can be carried out of the building in the head of the person who wrote them. The alpha is in how the signals interact. The portfolio construction layer, the risk model that holds 30 or 40 individual signals in a calibrated relationship across changing market regimes. The correlation structure that determines how capital moves between strategies when conditions shift. That layer is where the real intelligence lives. It is the part of the system that is least portable, most dependent on institutional memory, and hardest to reconstruct outside the environment that produced it. The researcher understands this now in a way that was not possible earlier. Understanding it is also what creates the next conversation. The portfolio manager approaches the desk on an ordinary afternoon. He says a book is opening, the researcher's own capital, the researcher's own signals, 10% of generated profits. He delivers the number the way someone reads a departure time. Factual, without emphasis. The researcher asks for a week. The week is spent not reviewing signals, which already exist, but constructing the risk framework around them. Drawdown rules, regime detection logic, escalation procedures for when the model's assumptions are being violated faster than the model can update. 6 days are spent looking for a structural flaw that cannot be answered. One does not appear. On day 7, the answer is yes. Managing capital is not a more senior version of researching it. The two things share vocabulary and almost nothing else. At 36, the book is $800 million. Not advised, not supported, managed. The base salary is fixed and modest relative to the arrangement. The variable component is 10% of profits generated. In a strong year, the book returns 16% on capital. That is $128 million in profit. The manager's share of that is $12.5 million. In a difficult year, the base sustains. Nothing else does. Every morning, the terminal opens and the positions update. The update is a verdict on the previous period's thinking. There is no manager above reviewing the logic. There is only the position and what the market has decided about it. $31 million was lost across 9 consecutive trading days when a volatility regime shifted faster than the correlation model anticipated. The physical response to numbers of that kind stopped arriving around month 7. A large loss with the wrong sign is not a crisis. It is a specific diagnostic event that requires a specific sequence of corrective steps. Reduce positions. Document which model assumptions failed. Update the framework, return to work. Being correct 52% of the time in this environment constitutes exceptional performance. The remaining 48% is not failure. It is the structure within which exceptional performance operates. The isolation is a condition nothing prepared the researcher for. At earlier levels, there was a team, a hierarchy, an internal conference, a shared vocabulary. Here, there is only the position and the market's daily judgment of it. The machine is genuinely constructed. The results are real. And then a number arrives from outside. At a conference that was nearly skipped, a panel discussion produces a number that the room receives without reaction. 66% average annual gross return. 36 consecutive years, 0 losing years. The room already knows the number. Nobody leans forward. Nobody asks for the methodology. The number is accepted the way a physical constant is accepted, as a fact about the world that you operate within and cannot alter. The flight home is spent sitting with the implication. This number was not produced by the hedge fund industry. It was produced by one fund that the hedge fund industry has spent 36 years failing to explain and has learned to accept as permanent. The fund in question does not accept outside capital. It has not since the early 1990s. Every dollar inside it belongs to the people who work there. Every improvement any researcher makes to the model moves their own wealth because every researcher is invested in the same structure. The incentive design is not a feature of the fund. It is the fund. The architecture and the edge are not separate things. The agreements that researchers inside this institution sign are not the agreements that exist elsewhere in systematic finance. The restriction is not a 2-year non-compete. It is permanent and broad enough that leaving the firm means leaving behind not just the specific work, but the framework for thinking about markets that the institution has spent 4 decades constructing inside its people. There is no paper describing the model, no conference where the methodology is presented. The researchers who built the foundational signals are not public figures. Some of them died years ago. Their signals are still running. The model is designed to outlast its components. It does. Every systematic framework that exists outside that one institution is a local approximation of something that institution solved at a global level before most of the tools used to solve it were widely available. This is not a ranking. It is a structural fact about the distance between what is accessible and what is not. The researcher who built a real machine, whose signals have held through multiple rate regimes, credit events, and sustained volatility compressions, is not failing to reach that ceiling. The ceiling was not part of the same race. The race at that level concluded before the current generation of researchers entered the field. Somewhere in a building that does not publicize its location, someone who has not left in 2 decades is running a test on a data set that does not yet appear in academic literature. The result will go into a model that will continue running long after the person who ran the test is gone. Several of the model's current signals already belong to people who are no longer alive. The terminal shows the overnight session opening, the positions update, the correlation matrix is reviewed, the risk report is scanned. The signals approaching regime boundaries are noted. The machine is real. The work is real. The results are real. They are also not the ceiling of what this class of work has ever produced. They have never been. That fact is not a reason to stop. It is simply the complete picture of the landscape. Every field contains a visible layer and a structural layer. The visible layer is what gets written about, described in interviews, and discussed at conferences. The structural layer is what actually generates the durable outcomes. The visible layer of quantitative finance is the signal, the pattern, the edge, the back-tested result. The structural layer is the combination, the risk architecture, the incentive design, the institutional memory that accumulates over decades and cannot be disassembled and reassembled somewhere else. Durable advantage in almost any domain follows this same pattern. The surface is portable, the structure is not. The second lesson is about permanence. A contribution made at any level of a well-designed system can outlast the person who made it. The signal still runs. The model still incorporates the work. The wealth it generates continues accumulating long after the contributor has moved on. Most compensation structures pay for presence. The systems that generate exceptional outcomes pay for contribution and allow the contribution to keep generating value after the contributor is gone. Understanding which type of system you are inside or building is one of the more important financial assessments available to anyone who earns a living through intellectual work. The machine you build matters. The architecture around the machine matters more. And somewhere between what is accessible and what is not, there is a distance worth understanding clearly, not because closing it is the point, but because knowing it exists changes the quality of every decision made inside the range that is actually reachable. The work continues. That is also the answer.